Oh, wait. Let's unpack this. In the often murky waters of investing, where talk of AI bubbles up and inflation worries kind of ebb and flow, there are some undeniable truths.
Hmm.
Like, you can debate the calorie count of cheesecake forever. You might live in blissful ignorance of whatever your cat's plotting.
Right.
And don't even get me started on reality TV drama.
Yeah.
But what's just real? Dividends.
Yeah. Actual cash. And it lands in your account. Doesn't really matter if the market's up or down that day.
Exactly. It sort of sidesteps all that speculation, doesn't it?
It really does. It's just a company sharing its profits with you, the shareholder.
Hmm.
The information we looked at makes that super clear dividends are, a fundamental reality.
Yeah. While everyone else is chasing hype or glued to forecasts, dividend investors are often just collecting income. Simple as that.
It's maybe less exciting sometimes, but potentially very rewarding.
Right. Now, here's the key thing, though. Not all dividend stocks are the same. Some cut payouts fast when things get rough, like a fad.
Yeah, definitely seen that happen.
But then you have the reliable ones, the stubborn old bulldogs, you could say,
Right.
weathering storms.
Mm-hmm.
Consistency. And today, we're diving deep into two companies like that known for paying dividends, like no matter what.
And that's crucial, isn't it? It's not just the yield percentage, it's the durability. Yeah. The business has to be strong enough to keep those payments coming, even growing them through thick and thin.
Okay, so first up, Realty Income, ticker symbol O.
ISO.
If dividends are facts, these guys are like the dictionary definition. They've even got that nickname, the Monthly Dividend Company.
Kids really lean into it. And for good reason.
Get this. Based on our sources, 639 consecutive monthly dividends since 1969.
Wow. Just think about that, 1969.
Moon landings, recessions, wars, disco.
Disco, yeah.
Oh,
And
yeah.
through all of that, the checks kept coming. Monthly.
So what's the secret sauce? What makes their business model so seemingly bulletproof?
Well, there are a few key things. First, who they rent to. They focus on big, stable, recognizable tenants. Think Walgreens, Dollar General, 7-Eleven.
Okay, household names.
Exactly. Not, risky little startups.
Right.
The source material had that funny contrast like Steve's Vape Shack. It highlights the difference in risk.
Right. No nail biting about Steve making rent. And then there are these triple net leases. How do they work?
Ah, yeah, triple nets.
Yeah.
Basically, it means the tenant pays for almost everything related to the property itself.
Everything. Like what?
Property taxes, routine maintenance, insurance. Realty Income, as the owner, mostly just collects the rent. The data we saw used a great analogy. It's like being a landlord, but without the headaches. Unclogging toilets, fixing leaky roofs.
Okay, I like the sound of that. Less hassle, more predictable income.
Precisely. It really cuts down their operating costs and makes the income stream much more stable.
Smart. Reliable tenants, long leases, tenants handle upkeep. What else?
The diversification.
Yeah.
Huge factor. They have, over 13,000 properties now?
13,000.
Yeah. So if one tenant, even a big one like Walgreens, closes a few stores, it barely makes a dent in Realty Income's overall picture.
Right, it's just a drop in a very large bucket.
Exactly. It really mitigates that single tenant risk.
And it's not just paying dividends, they've been increasing them too, haven't they?
Oh, absolutely. Over 120 times since they went public back in '94.
Wow.
That shows a real commitment, returning value. Plus, it helps your income keep up with inflation over time. Crucial for, say, retirement planning.
Definitely. Now, okay, reality check time. Every investment has potential issues. Rising interest rates. That puts pressure on REITs, right? Realty Income is a REIT, a real estate investment trust.
That's a very important point. Yeah, rising rates make borrowing more expensive. That can affect profits' ability to buy new properties.
So how do they handle that? Are they just stuck?
No, not at all. I mean, they've been around since '69. They've seen plenty of rate cycles. Their management is experienced. They adapt.
How?
Well, they do things like refinancing debt smartly. Plus, their focus helps. They tend to lease to sectors that hold up pretty well in downturns. Think dollar stores, convenience stores.
Yeah.
Essential stuff.
Recession-resistant sectors. Makes sense. Keep occupancy high.
Exactly. Helps maintain that steady rental income, even when the broader economy is shaky.
So, despite those pressures, they have ways to navigate. And the yield right now, what are we looking at?
The info suggests it's around 5.6% paid monthly.
5.6% monthly.
Yeah. And the source material kind of asks, How does that stack up against your standard savings account yield, which is often tiny and comes with restrictions? It's a fair question.
It really is. Okay, let's switch gears. Let's talk about a dividend you can, well, almost taste. PepsiCo, ticker PEP.
PEP, yeah, a household name for sure.
And this is a company that seems to do well no matter what, right? Especially recessions. People need their comfort food, soda, chips.
Oh, absolutely. And it's so much more than just PepsiCo. You've got Gatorade, Quaker Oats, Lay's, Cheetos, Doritos, Tropicana.
Mm-hmm.
The list goes on. They dominate snacks and beverages.
Huge portfolio.
That diversification across products is another layer of stability for them.
So what makes their dividends so reliable? Why is it also considered, bulletproof?
Well, similar logic in some ways. First, they're a consumer staple. People buy food and drinks regardless of what the economy's doing.
Right. Wars, inflation. The source even joked about asteroid threats or your favorite show getting canceled. People still buy snacks.
Pretty much. These aren't usually the first things people cut back on.
And they have that brand power, right? Pricing power.
Huge pricing power.
Yeah.
Because the brands are so strong, they can nudge prices up a little bit. You might grumble about Doritos costing a few cents more, but...
Probably still buy them.
Exactly. Call it brand loyalty, call it emotional snacking, whatever. It works. Those small increases add up across billions of sales.
Plus, they're not just in the U.S.
Nope. Global giant. Operating in over 200 countries. That geographic spread is massive for stability. If one market's having a tough time, others can pick up the slack.
And the dividend history itself. Pretty impressive.
Very impressive. They're a dividend aristocrat, that means. They've increased their dividend for at least 25 years straight. PepsiCo, 52 years.
52, wow.
Yeah. Think about the history they've peed through. The 70s stagflation, the 80s boom, dot-com bust, 2008 crisis, the whole 2020s mess.
Still increasing the dividend.
Every year.
Yeah.
That track record. It really speaks volumes about their resilience and their commitment.
Okay, but the yield is lower than Realty Income, around 3% based on what we saw. What's the deal there?
Yeah, it is lower. And that's often the trade-off with these huge, stable blue-chip companies. You get incredible reliability, decades of dividend growth, and usually share price growth too. Capital appreciation.
So less immediate income, but maybe more overall growth and safety.
Kinda, yeah. It's often seen as more of a sleep well at night stock. You're not expecting explosive growth, maybe, but you are expecting consistency. Sometimes, as the source material joked, boring is actually pretty sexy.
Huh. Fair enough. So we looked at these two stalwarts, Realty Income and PepsiCo. Let's zoom out a bit. Why do dividends even matter so much today, especially with all the noise about, crypto, meme stocks, all that shiny stuff?
That's such a key question, because in a market that often feels driven by hype, dividends are tangible. They're real.
Cold, hard cash, like you said.
Exactly. That's number one. Number two, a company consistently paying and growing dividends. It's usually a sign of actual profitability and a genuine commitment to shareholders. They're not just saying they're doing well, they're proving it by sharing the profits.
And it's not just the check you get today, right? There's a longer-term thing happening.
Oh, absolutely. Compounding. It's like magic, but, math. When you reinvest those dividends...
You buy more shares.
Right. Which means next time you get a slightly bigger dividend payment, which buys even more shares.
Yeah.
It snowballs over time. It builds wealth.
And you're not just relying on finding someone to buy the stock from you at a higher price.
Exactly. You're avoiding that greater fool theory. Your return comes partly from the company's actual success paid out to you. Even a small amount, reinvested consistently in a company like PepsiCo over decades, it can really add up.
That reinvestment part sounds powerful. Almost takes the stress out of watching the market every single day.
It really can. If you're focused on that growing income stream, the daily price swings matter less. Your goal is accumulating more shares that pay you. Realty Income, PepsiCo. They're living proof of this, not just promises.
Okay, powerful case. But let's be balanced. No investment is totally risk-free. What are the potential downsides, the reality checks for these two?
Absolutely crucial to acknowledge risk. For Realty Income, well, the nightmare scenario, probably very unlikely, is a total collapse of physical retail.
Given their tenants, Walgreens, dollar store seems unlikely.
Extremely unlikely given who they rent to. But technically it's a risk. For PepsiCo, maybe a sudden, massive global shift to only super healthy eating.
Also seems improbable, given, human nature and Doritos.
Right. The sources kind of humorously suggest the same thing. These are pretty low probability risks for these specific companies.
So the main point is their resilience.
Yeah. Both have shown they can adapt over decades. They've navigated huge economic shifts, changing tastes, and kept paying those dividends.
Which brings us to some maybe rules of the road for dividend investing that came up in the sources. What should you, the listener, keep in mind?
Good idea. Rule 1. Focus on the business, not just the yield number. Is it strong? Healthy financials. Proven track record. A super high yield can sometimes be a red flag, actually.
Meaning the company might be in trouble and the dividend isn't sustainable.
Exactly. Rule 2. Reinvest those dividends. Let compounding do its work for you over the long term.
Makes sense.
Rule 3. Diversify. Don't put all your eggs in one basket, not even these two baskets. Spread your investments around.
Always good advice.
And Rule 4. Pay attention to dividend safety. Look at things like the payout ratio. How much of their earnings are they paying out? Is it sustainable? Check their cash flow, their balance sheet health.
Okay, good practical tips. So, bringing it all home, what's the big takeaway here about dividends?
I think the main thing is dependability. In an investment world full of noise, forecasts, hype, dividends are just straightforward facts.
Market trends change, analysts get it wrong, CEOs make promises. Even your portfolio app might glitch out sometimes.
Oh, yeah. But the dividend payment, it's binary. You either get paid or you don't.
Yeah.
That simplicity, that reliability, it's powerful.
And Realty Income and PepsiCo seem like prime examples of companies prioritizing that reliability, that shareholder return over just hype.
Absolutely. Their whole history speaks to building businesses that deliver consistent value through those dividend checks. It's baked into their DNA, seemingly.
So, bottom line, if you value getting that consistent income, that tangible cash landing in your account, maybe thinking like a dividend investor is worth considering.
Definitely. And here's a final thought to leave you with. When the next market tip happens, it will happen eventually, sure, maybe you feel a bit smug if you're prepared, but actually receiving those dividend checks while others are panicking, that's a concrete benefit.
Reinforces the whole idea.
Yeah. It really underscores the value of patient, smart investing focused on collecting those checks over the long haul.